All right, let's jump right into this explainer. Today, we're looking at a dramatic, very recent event that really forces us to view this massive AI build-out not as some far-off sci-fi future, but as a real-time financial thriller. We hear so much about how artificial intelligence is going to transform the entire world. But right now, we're just going to look strictly at the math, the leverage, and the physical infrastructure that is propping up this entire multi-trillion-dollar narrative.
So it really begs the question, right? Has the AI bubble actually already started to burst? Well, to answer that, we aren't going to look at Silicon Valley just yet. Instead, we're taking a trip over to South Korea to see what an unraveling actually looks like in practice. Why South Korea? Because their stock market essentially just ran a faster, smaller, and way more concentrated version of the exact same leveraged playbook we are seeing unfold right now in the United States.
Get this, the South Korean Kospi stock market didn't just have a minor correction, it plummeted a staggering 25% in just 21 days. I mean, that kind of violent drop wiped out 1.2 million retail investor accounts practically overnight. To put that into perspective, that translates to roughly 1 in every 30 people in the entire country taking a massive financial hit. So how on earth did a modern economy watch its stock market just evaporate that quickly?
The underlying danger here comes down to extreme concentration. A massive 56% of that entire stock market was concentrated in just two memory chip stocks, Samsung and SK Hynix. And these two companies are absolutely crucial. They produce the hardware that feeds data into AI processors. Now, this heavily concentrated market was being propped up by retail investors who were using vast amounts of borrowed money, placing their bets on leveraged funds that just multiply the market's daily movements.
And all that borrowed money is exactly what triggered what's known in finance as a margin call doom loop. Basically, when U.S. chip stocks wobbled just a little bit, it sent a shockwave straight to Korea. It works like this. Step 1, the stock drops. Step 2, the broker demands cash to cover the borrowed money. Step 3, everyday investors who don't have that cash laying around are forced to sell their shares at a massive loss. And finally, step 4, all that forced automatic selling pushes the price even lower, which just triggers more margin calls. During this crash, normal liquidation rates in Korea spiked from around 2% to over 10%. It was literally a mathematical avalanche.
And this brings us to the much bigger macro risk. Because South Korea wasn't just trading in a vacuum. They were placing a highly leveraged bet on the estimated $1.5 trillion in infrastructure spending that's been projected by U.S. tech giants over the coming year. South Korea is the one supplying the memory chips for the American AI build-out. Their investors were essentially betting that companies like Microsoft, Meta, and Google would just keep spending billions upon billions of dollars forever.
Which means we really need to understand the economics behind all that U.S. spending. Let's compare traditional real estate to these new AI data centers. A lot of capital providers out there falsely view data centers as these safe, multi-tenant real estate investments. Like, you buy an apartment building, you pay an upfront cost, the building lasts for decades, and you just collect a steady rent check. But AI data centers, they are the exact opposite. They are short-duration projects that require continuous, massive capital upgrades, housing hardware that fails incredibly fast. So the crucial point we have to ask is, what is the rent that these data centers are actually collecting? Well, it's tokens. Tokens are the underlying commodity widget produced by these AI data center factories. Whenever you interact with an AI model, it generates tokens. But unlike traditional commodities like oil or gold, tokens are hyper-deflationary. We are currently building the most expensive factories in human history to produce a product that is rapidly losing its pricing power. How rapidly? Well, token prices have actually been plummeting by 70 to 80% year over year on a constant performance basis. Open source models and just intense market competition are driving the price of AI intelligence straight into the floor. Think about it. It is mathematically terrifying to promise fixed returns to your investors on a rapidly depreciating hardware asset when that asset produces a commodity that's actively crashing in value. This whole situation paints a picture of deeply broken unit economics. You've got GPUs that are used for heavy AI training failing in as little as 18 months. So you have to constantly rip out old hardware just to install the newest generation. And at the exact same time, open source models are turning the intelligence itself into a cheap commodity. So you end up with a massive asset intensity of a public utility company. But investors are treating these projects with the sky-high financial expectations of a high-margin software business. It just doesn't match up. To really grasp the broader danger of this, we have to look back at our own history here in the U.S., because the parallel to South Korea is honestly stark. We have to look at U.S. margin debt,
which again is the borrowed money Americans use to buy stocks. Historically speaking, margin debt has peaked right before our absolute worst financial crashes. August 1987, before Black Monday, March 2000, before the dot-com bust, and July 2007, right before the financial crisis. And where exactly are we today? Officially recorded U.S. margin debt currently sits at roughly 4.5% of our GDP. That is the highest level ever recorded in American history. And keep in mind, that figure doesn't even track hidden leverage, like highly speculative zero-day options or leveraged ETFs. What this tells us is that the U.S. market right now is a massive, heavily leveraged bet on the AI growth story continuing indefinitely, without a single pause. But if we look inside those massive U.S. companies, the hyperscalers making these huge AI bets, we see a pretty disturbing trend. The returns on all that massive spending are actively shrinking. Just 18 months ago, hyperscalers generated about 40 cents of operating income per invested dollar. Today, that has been slashed in half to 20 cents, and the trajectory has it heading steadily downward toward 10 cents. So with record-breaking historical leverage stacked up in the broader market and shrinking returns happening inside the data centers themselves, we have to ask the ultimate question. What exactly will cause the music to stop playing? What's the catalyst that pops this bubble? The answer lies in a single metric. The metric that matters more than anything else right now is a cut in capital expenditures, or CapEx. The very moment just one of the trillion-dollar hyperscalers, like Microsoft, Google, or Meta, announces on an earnings call that they are reducing their AI spending, the dominoes are going to fall. It's exactly what happened in the year 2000 when Cisco saw its orders suddenly drop. A single cut in spending will collapse the anticipated earnings of the chip suppliers, and it'll trigger that exact same margin called doom loop we just watched unfold over in South Korea.
And this brings up a fantastic point from the famous short seller Jim Chanos. He points out that eventually a CEO is going to sit down, put pencil to paper, and realize they could make better, significantly safer returns by simply buying government bonds. I mean, why spend hundreds of billions ripping out GPUs every 2 years to sell deflating tokens when you can just park that cash in treasuries and avoid the massive operational risk altogether?
Yet, despite all this underlying math, the market just continues to pour capital in based entirely on the almost mystical promise of creating AGI, or artificial general intelligence. The market is displaying an absolute confidence that eerily mirrors the vice president of the White Star Line, who famously declared the Titanic unsinkable, right after it had already hit the iceberg. Right now, market momentum and groupthink are just completely overpowering basic unit economics. Now, make no mistake, AI is an incredibly transformative technology, and it absolutely will survive this financial cycle. But ultimately, this is where we're heading. These massive models will fade into the background as a cheap utility, unseen, ubiquitous, and priced like water or electricity. Much like the hydroelectric dam that invisibly powers your laptop today, you really aren't going to know or care which multi-billion-dollar data center generated the tokens you're using to draft an email. So, I want to leave you with this provocative thought to ponder. As the underlying technology commoditizes and the massive hype finally settles down, who is actually going to be left holding the bag for the greatest, most expensive financial experiment of our time? Thanks for diving into this explainer with me today. Keep asking the hard questions about the mechanics behind those flashy headlines, and I'll catch you on the next one.